In this part you will learn journal entries for issue of shares at par. Remember that following journal entries are passed when the shares are issued at par. That means face value of a share is equal to issue price of the share. First journal entry is passed for receipt of application money. The journal entry is bank account debit to equity share application account. Remember that according to the Companies Act 1956, the application money collected should not be less than 5% of the face value of shares. Next journal entry is for transferring the application money to the capital account. The journal entry is equity share application account debit to equity share capital. For making allotment money due from the shareholders, following journal entry is passed. Equity share allotment account debit to equity share capital account. For receiving allotment money, following journal entry is passed. Bank account debit to equity share allotment account. For making first and final call money due, following journal entry is passed. Equity share first and final call account debit to equity share capital. For receiving the first and final call money, following journal entry is passed. Bank account debit to equity share first and final call. Calls in arrears. All shareholders do not pay the call money as and when demanded. The amount receivable from them is called calls in arrears. Thus, calls in arrears are unpaid calls. The amount of unpaid call is transferred to a separate account called calls in arrears account. Say for example, if the first call money is not paid by the shareholder, then we pass a journal entry calls in arrears account debit to first and final call account. Company sends call reminders to the shareholders reminding them that they have to pay that amount to the company. In response to the call reminders, some shareholders may pay this amount at a later date. On receipt of the amount, bank account is debited and calls in arrears account is credited. Company is allowed to charge interest on calls in arrears. Unless given otherwise in the articles of association of the company, the rate of interest on calls in arrears is 5% per annum, and it is calculated from the last date of payment of call to the date of actual payment of call money. When interest is received, we pass an entry bank account debit to interest on calls in arrears account. And at the year end, this interest is transferred to profit and loss account with an entry interest on calls in arrears account debit to profit and loss account. Let us take a practical example for understanding the journal entries in a better way. Please read the following example. Whenever such problems are asked, it is always better to analyze them. Let us learn how to analyze them. It is given in the problem that the authorized and issued share capital is 3 lakh shares of 10 rupees each. These 10 rupees are collected in the following manner. On application rupee 1, on allotment rupees 2, on first call rupees 3, and on final call rupees 4. First call money is in arrears for 5,000 shares and the final call money is in arrears for 12,000 shares. Subscribed share capital is 3 lakh shares of rupee 10 each. We have been asked to give journal entries. Following journal entries will be passed in the books of A Limited. Since 3 lakh shares are sold and application money is rupee 1 per share, the first journal entry would be bank account debit to equity share application account rupees 3 lakhs. The application money so received will be transferred to share capital account with a journal entry equity share application account debit to equity share capital account. After this, rupees 2 per share will be due on allotment. The journal entry that is passed is equity share allotment account debit 3 lakh shares multiplied by 2 rupees, that is 6 lakhs, to equity share capital account 6 lakhs. Nobody has made a default in payment of allotment money, so all money will be received. Entry will be bank account debit 6 lakhs to equity share allotment account 6 lakhs. Then first call money will be due at the rate of 3 rupees per share on 3 lakh shares. Equity share first call account debit 9 lakhs to equity share capital 9 lakhs. First call money is not received on 5,000 shares, and therefore we pass an entry bank account debit 2 lakhs 95,000 shares multiplied by 3, that is 8 lakhs 85,000. Calls in arrears account debit 5,000 multiplied by 3, 15,000, to equity share first call 3 lakhs multiplied by 3, that is 9 lakhs. Here you must have observed that the money that is not received or calls in arrears are transferred to a separate account. Now second and final call money will be shown as due. Remember that second and final call money will be due on all 3 lakh shares, and therefore journal entry would be equity share second and final call account debit to equity share capital 3 lakh shares multiplied by rupee 4 per share, that is rupees 12 lakhs are due. Since the final call money is not received on 12,000 shares, we pass an entry bank account debit 3 lakhs 88,000 shares multiplied by 4, that is 11 lakhs 52,000. Calls in arrears account debit 12,000 shares multiplied by 4 rupees per share, that is 48,000, and to equity share second and final call account 12 lakhs, that is 3 lakhs multiplied by 4. Calls in advances. If the articles of association of the company so provide, the shareholders can pay their call money in advance of making the call. The authority to make the call rests with board of directors. They decide the amount of money to be called from the shareholders. Calls in advances is an amount received in advance of making the call by the board of directors. For recording this advance money received, we pass an entry bank account debit to calls in advances account. As and when the board of directors take a decision about the money to be called from the shareholders, the amount of calls in advances is transferred to the respective calls. For transferring the amount of calls in advances to the respective calls, we pass an entry calls in advances account debit to respective call account, say first call or second call account as the case may be. Calls in advances is the money received from shareholders in advance. Therefore, company may pay interest at the rate of 6% calculated from the date of payment of advance till the date of making the call. For recording the payment of interest on calls in advances, we pass an entry interest on calls in advances account debit to bank. At the end of the year, the amount of interest on calls in advances is transferred to profit and loss account with the following entry profit and loss account debit to interest on calls in advances account. In the next PowerPoint presentation, you will be learning about issue of share capital.